Hello everyone, welcome to our Business Education and Research channel. In this video, we will explore the world of mutual funds and why they are an excellent investment outlet for both new and seasoned investors. Whether you are looking for growth, income, or balanced approach, mutual funds offer a variety of options to match your financial goals. By the end of this video, you will have a solid understanding of how mutual funds work and how to choose the right one for your portfolio. To start with, let us try to understand the concept of mutual funds. Mutual funds pools money from multiple investors to purchase securities such as stocks, bonds, or other assets. The combined holdings of the mutual funds are known as its portfolio. Managed by professional fund managers, these funds offer a simple way to gain exposure to various asset classes without requiring extensive investment knowledge. There are different types of mutual funds, including equity funds, bond funds, balanced funds, and index funds. Each type offers different investment objectives and risk levels, allowing investors to select funds that align with their financial goals and time horizons. For example, if you invest in the SBI Blue Chip Fund, your money is pooled with other investors' funds to buy shares of large capital companies like HDFC Bank, Infosys, and Reliance Industries. This provides diversification and professional management, reducing individual stock risk. Mutual funds are managed by experienced professionals who research, analyze, and make investment decisions on behalf of the investors. This is particularly beneficial for those who lack the time or knowledge to manage their investments actively, as it allows them to benefit from expert management. A key advantage of mutual funds is diversification. By investing in a variety of assets, mutual funds reduce the risk associated with individual securities. This diversification helps stabilize returns over time, providing a smoother investment experience. For example, consider the ICICI Prudential Balanced Advantage Fund, which invests in both equities and debt instruments. This fund offers diversification by spreading investments across different assets classes, thereby reducing the overall risk. Equity funds. Equity funds primarily invest in stocks and are suitable for investors seeking long-term capital growth. These funds are categorized based on market capitalization such as large cap, mid cap, and small cap funds, each offering different levels of risk and return. Debt funds. Debt funds invest in fixed income securities like government and corporate bonds. They are generally less volatile than equity funds and are ideal for conservative investors looking for steady income with lower risk. For example, an investor might choose the HDFC Short-Term Debt Fund, which focuses on short-term debt instruments like government securities and highly rated corporate bonds offering stability and lower risk. Equity funds offer high growth potential by investing in diverse portfolio of stocks. These funds are suited for investors with higher risk tolerance and long-term investment horizon, aiming for significant capital appreciation. Equity funds can be categorized by market capitalization, large cap funds investing in established companies, mid cap funds targeting medium sized companies, and small cap funds focusing on smaller companies with high growth potential. For example, the Axis Blue Chip Fund focuses on large cap companies providing stable growth, while Nippon India Small Cap Funds target small, high growth companies with higher volatility. Systematic investment plan, that is the power of regular investments. What is SIP? Systematic investment plan allows investors to invest a fixed amount regularly in mutual fund scheme. SIPs encourage disciplined investing and reduce the impact of market volatility through rupee cost averaging, making it easier to build wealth over time. Benefits of SIP. SIPs make investing accessible to everyone, even those with a smaller budget. Regular investments, no matter how small, can grow significantly due to the power of compounding, helping investors to achieve their long-term financial goals. For example, an investor might start monthly SIP of 2000 in the Mira Asset Emerging blue chip fund. Over 15 years, this regular investment can grow substantially, benefiting from market growth and compounding returns. Tax benefits of mutual funds. ELSS, Equity Linked Savings Scheme. ELSS funds provide tax benefits under Section 80C of the Income Tax Act, allowing investors to claim reductions of up to 1.5 lakhs per year. These funds invest primarily in equities and have lock-in period of 3 years, offering both tax savings and potential long-term capital growth. Capital gain tax. The mutual funds are subject to capital gains tax based on holding period. Long-term capital gains, that is LTCG, from equity mutual funds are taxed at 10% for gains exceeding 1 lakh per year, while short-term capital gains are taxed at 15%. Debt funds have different tax rules, with LTCG taxed at 20% after indexation of benefits. For example, an investor in India investing 1.5 lakh in Axis long-term equity funds can save up to 46,800 in taxes for the 30% tax bracket, while also aiming for potential capital appreciation. After a 3-year lock-in, any gains are subject to LTCG tax, making it a tax-efficient investment option. How to choose a mutual fund? Selecting the right mutual fund. Assessing risk tolerance. Investors should choose mutual funds that align with their risk tolerance. Those with higher risk tolerance may opt for equity funds, while conservative investors may prefer debt or hybrid funds. Assessing your risk appetite is crucial for selecting the right mutual fund. Evaluating fund performance. It is essential to evaluate a mutual fund's past performance, expenses ratio, and the expertise of the fund manager. Consistent performance across different market cycles and a lower expense ratio are indicators of reliable fund. This evaluation helps ensure the chosen fund aligns with your financial goals. For example, before investing in the Aditya Birla Sun Life Tax Relief 96 fund, an investor might review its historical returns, compare it with similar funds, and check the expenses ratio. If the fund consistently outperforms its benchmark and peers, it may be a good for their investment portfolio. Common mistakes to avoid. Ignoring risk and return. Many investors focus solely on potential returns without considering the associated risk. It is essential to balance the potential returns with your risk tolerance and investment horizon. Ignoring this balance can lead to poor investment outcome. Lack of diversification. Relying too heavily on a single type of fund or investment can increase the risk. Diversification across different types of mutual funds and asset classes helps spread risk and can lead to more consistent returns over time. For example, an investor who only invests in small cap funds may experience significant volatility. By diversifying into a mix of equity, debt, and hybrid funds, the investor can reduce overall portfolio risk and achieve more balanced growth. Thank you for watching. We hope this video has provided valuable insights into mutual funds as an investment outlet. Remember, the key to successful investing lies in understanding your goals, assessing your risk tolerance, and making informed decisions. Mutual funds offer a flexible, accessible way to grow your wealth, so take the time to choose the right one for your portfolio. Don't forget to like, share, and subscribe for more financial education content. See you in the next video. Thank you.